In this video, I'll be walking you through the 5 most common mistakes that successful people make, causing them to overpay the IRS every single year, often by tens of thousands of dollars that they never had to give up. Through working with business owners and high earners at Prospective Wealth, I've discovered that overpaying on taxes is rarely a lack of effort. It's more about a handful of specific and fixable mistakes that nobody catches until we look at the full picture. That's exactly why I'm making this video today, to walk you through the 5 mistakes, what each one of them is costing you, and how to stop making them so your money stays with you instead of going to the government. So let's get right into it. First and foremost, let's talk about how this is even happening. Why does it seem like there's this cycle every year of you send all your stuff to your CPA and you get it back and there's usually a surprise. It's a larger tax bill than you were expecting, and you're wondering what tax strategies are even being implemented. There has to be some things that I'm not doing. What fundamentally goes wrong for most folks is they have hired their CPA thinking they hired a tax strategist, a tax planner, when that's not really what their CPA's job is. Their CPA's job is compliance. It's to make sure that they are doing the tax return accurately and compliantly. So tax preparation and tax planning are 2 different things. And that's really what's causing this issue where these 5 mistakes really kick in. Let's get into the 5 mistakes. Mistake number 1 is they're treating tax planning as a once-a-year event. I gave my stuff to the CPA, they did my tax return. That's tax planning, right? No, tax planning to us is a year-round process. And it's easily put as there's a fall tax planning meeting scheduled where the tax return's actually read line by line. There's tax modeling being done to project potential outcomes or strategies. We have a list of over 100 tax strategies that we evaluate for clients, and that's when those strategies are brought to life. Also, infusing tax as a lens through every financial planning conversation brings this year-round tax planning process into the mix rather than this one single event that's done at the tax return completion. Now, mistake number 2 is structural. So we find that folks are not building their balance sheet in a way that is tax efficient. That could happen at the entity level. They're a business owner. Maybe they should be a partnership or an S Corp or a C Corp. But it also, even deeper, is how they arrange their balance sheet and the types of accounts and structures that they use. So I built a really simple, just 4 bucket, kind of 4 categories of tax outline for you just to help educate around the 4 options that you have. But most people live in bucket 1. They live in the taxable bucket. So they're paying tax every single year on whatever it is that they make. We want to shift away from that with as many assets as we can and structurally build out the other 3. And that starts with tax deferred. Now, tax deferred is most commonly the retirement account bucket where we're choosing not to pay tax today. We're going to pay tax later. That works really, really well when effective tax modeling has been done and we can figure out, okay, they're at a 37% bracket today. They're tracking for a 24% bracket later. Then we can take advantage of that tax bracket drop. That's where tax deferred makes a lot of sense. Now, there's a couple of strategies on there you've probably never seen before, and I'm actually going to break one of those down here in just a second. But most importantly, I want to touch on tax-free. Tax-free is the bucket we should all want to be living in. We find that very little effort and thought is put towards the tax-free bucket. That's where Roth and some of these other kind of more unique strategies start to live. What we find to take advantage of the tax-free bucket, you have to be really, really focused because there's not an easy, I can just dump $500,000 or $100,000 into the tax-free bucket. We have to build that up. That takes a lot of thoughtful planning over time. 4th bucket is tax advantage. That's really the capital gains bucket, the 15 or 20% tax rate that you're going to find on capital gains or qualified dividends. We want to build those up. Those are taxed really efficient. I'd much rather be paying 15 or 20% than 37% on income. So now that you understand the buckets and the structure, and you can understand that, once a year thinking is costing you a lot, if you want a real plan that's actually built around your specific situation, click the link below. Schedule a call with our team at Prospective Wealth. We're here to look at your specific situation and show you how to optimize your plan all together so we can apply to your exact situation. Now, mistake number 3 is leaving the big tax shelters on the table. I'm going to give you 2 examples. One, I mentioned the tax-free bucket. That's That's hard to build up. But the fastest way we can build that up is through something called the mega backdoor Roth. We have clients saving upwards of $40,000, $50,000 a year in Roth through the mega backdoor Roth. That is one of the most unused tax strategies that's just sitting there for a lot of people. The second is something called a cash balance plan. I actually built out a model to show you just the difference between utilizing a cash balance plan and this tax bracket drop concept versus just sticking it in a taxable account and having taxes erode at your outcomes every single year. So this is just a real simple Jim here. He's saving $100,000 a year, and he's going to do that from 55 to 65. He's going to retire at 65 and try to spend all those dollars down till he's 75, just for the sake of ease. I modeled it that way. So in a cash balance plan, this is actually a really special thing that business owners get to take advantage of. Most of them have never even heard of this, where you get to put $100,000 in, but you don't pay tax. You actually get to write that off this year. Now you will pay it later, but you get to write it off this year. So I actually get to invest $100,000 in year one, and I get to do that every year for 10 years. So after 10 years at an 8% rate of return, I have $1.5 million. Now, compare that to if I were to put that in a taxable account. Well, to get money in there, I want to put $100,000 in, but I got to pay tax. So I got to pay $37,000 in tax. So I'm actually only putting $63,000 in. Do that for 10 years with an 8% rate of return. I have $964,000. Quite a bit less than the cash balance plan. Now, at 65, I'm going to start taking that money out. The cash balance plan allows for $43,000 a year more in income to get it depleted in 10 years than the taxable account. That's a value of $437,000 more that I'm going to have using this tax drop concept in my financial plan. The 37% rate that I'm paying today is then 24% later. This works if I've done effective tax modeling and I know that I'm headed for a tax bracket drop. Now, a lot of people, they have no idea what they're headed for. And in a lot of cases, they're actually headed for a tax bomb because of how they built up their balance sheet. That's why structure really matters. Using some of these tax shelters can really help with that. Now, let's talk about mistake 4 and 5. Number 4 it goes back to this tax team I talked about at the beginning where they have a CPA and that's it. Because the advisor doesn't talk tax. They have an advisor that does not talk tax. What we find is if we can get synergy where the wealth advisor and the CPA are talking, they're linked together, where they're working on your behalf together, that's where so many of these tax strategies can be implemented that weren't going to happen when they work separately, when the wealth advisor and the tax person, CPA, doesn't even know one another. Now, the 5th is a lack of a tax projection, a lack of a tax model. Most folks have never come to us and say, yeah, I've got this tax projection that's been built to show me what I'm tracking for, or at least they've never even had their advisor speak to that. So they really don't know what are they headed for. Am I at 65 headed for a tax bomb, or am I headed for that tax bracket drop that I can really take advantage of some unique strategies? Those 5 mistakes are what are killing people and causing them to pay substantially more in tax. So let me walk you through what it actually looks like when we have these things working in harmony. This is a synergistic financial plan where every domain, the major 6 domains, are talking to one another and they're centered around your goals. If you don't have that, it's really hard to do effective tax planning because you sometimes have the left hand and the right hand not talking to one another. So once we have synergy, what does that actually end up looking like? Well, we find that there's 8 domains that need to be built out for a full picture financial plan. But I want to spend some time really harping on the tax projection for a minute. See, if we don't have everything kind of pointing to and then through that tax projection, we're going to leave a lot on the table. An example, retirement tracking. That needs to be ran through a tax lens. That needs to have a tax projection to it. Great example. A lot of people out there converting from pre-tax to Roth because someone told them to do it. They saw someone on YouTube tell them they should do it. But that might not actually be a very favorable tax strategy for you. You need the tax projection. You need tax modeling built to figure out how am I tracking in retirement for taxes and should I be utilizing some of those strategies? Another example is estate planning. Estate planning needs to be pointed through a tax lens. You can do things in your estate plan that will create a taxable event if you're not careful. Equity modeling is another really big one. That's where a majority of your wealth is getting built up, is in equity. And if, I sell and I don't get ahead of taxes, or I trigger this taxable event and I wasn't prepared, that's why we need those tax projections. We know, in 5 years we're selling the business, or in 3 years my RSUs are going to vest. That matters a lot. Then the last piece is investing. The portfolio architecture needs to have this tax efficient lens to it. We need to have tax smart investing applied, and that is where the tax projection is ran through our investment strategy. Now, you've seen the 5 common mistakes that are making you overpay in taxes, and you're treating taxes as a once a year event, or the wrong structure in your balance sheet, or your unused tax shelters, the coordination gap, and lastly, a lack of tax rejection. You can stop handing the government more money that you never had to give them. If you want a real plan built around your specific situation, click the link below to schedule a call with our team at Prospective Wealth. We're here to show you exactly how to stop overpaying for your specific situation. I'll see you in the next video.